Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with ASB. Today I want to talk about an obscure report that's come out of the IMF up north. This shows that banks, particularly in the United States and in Europe, are expected to lose $4 trillion from the toxic debt on various property markets around the world. Why does this matter for us? Well, not directly. Our banks are sound and certainly don't have anything like those amounts of losses. But what this means is that the global economic slowdown is likely to be longer and harder than many expect. That's because we've got a global deleveraging process going on. And when you have $4 trillion worth of bank losses, that's going to filter down to us in one way or another. Just to explain, before the bursting of the credit bubble, banks had leveraged themselves up to the tune of perhaps 25 times their equity. So they would have $1 of their own money, if you like, and lend $25 out to other people. Now that means if you lose that $1, you have to pull back those $25. And at the moment we're going to see the banks deleverage as well on top of that. So that $4 trillion of losses turns into a deleveraging of $100 trillion. What will that mean? Well, international banks will pull lending back to their home countries, particularly if they've been nationalised and the politicians want them to do that. What does it mean for us? Well, long term it means the economy, the global economy, will be slower and the recession deeper and longer than many people expect. Export prices will be low, the number of tourists coming will be low. And our interest rates will remain relatively high, particularly for longer-term fixed-rate borrowers. I'm Bernard Hickey. That was a special report brought to you in association with ASB.